Hello, this is Eric Boyce, CEO and Chief Investment Officer of BKA Wealth Consulting, and welcome to Charts and Chat for September 12th of 2022. Your disclaimer for important information. In our weekly high frequency data, we haven't shown you this slide in several weeks. Obviously, the data gyrates around quite a bit, but I thought it'd be good to check in. We probably won't do this on a weekly basis, but every so often, about every 3-4 weeks or so, probably be good to check in. We look at the data here, and I'm going to focus really on the month-over-month data because that's really most telling in the trends that we're seeing with this economic slowdown. If you look at steel production, some of the industrial numbers here, we've got steel production down slightly. We know manufacturing is off a little bit. Rail car traffic is up about 3.3%. You see here, and then you get down in more consumer-focused areas. You got hotel occupancy that's down around 10% month over month. We do know that we're entering the fall, which is getting out of the historical travel season, so there is some seasonality impacts there. Open table restaurant data, that's up about 11%. We do see that trending higher relative to 2019 now, so that's been a change that we've noted here since we last presented these numbers to you. TSA checkpoint data down around 6.5%. Again, I think owing in some part due to the end of the travel season, again, looking at that month over month figure. And then we've got global commercial flights down around 6%, again, kind of dovetailing with the TSA data. And then motor gasoline, we do see down around 4.3, and that's still down relative to 2019, as is the commercial flight level. But we do see TSA checkpoint data now actually trending higher than 2019. Now, trending into some of the various economic slides that we have for you this week, we've got the PMI Services Business Activity Indicator in the aqua line that you see there, overlaid against the bars in the gray, which is private services gross output. And so, we see that business activity is really kind of in many cases, a coincident indicator, but in this case, some of this data comes to us at a bit of a time lag. But what we do see in business activity is it is clearly trending lower. And we do see this falling into contraction territory. I mean, these are diffusion type numbers. And so you see that anything below a 50 on that index, is going to be in contraction territory. You would expect that to find its way into the gross output numbers as well when they're reported, that they're going to show that downtrend. You can see the relationship here is relatively strong. Again, not a surprise to anything that we've seen or we have been watching. I mean, this is a trend and a course that we've been charting for some time. And here we have a consumer sentiment indicator, and this is actually overlaid two different numbers. We've got Goldman Sachs Economic Sentiment Index overlaid with the University of Michigan Consumer Sentiment number, which we know is highly influenced by levels of perceived and realized inflation. And we see in a bit of a kind of reversal. We've seen a consistent downturn for about a year now, and we see that turning back up. A lot of that has to do with gasoline prices, at least from the University of Michigan standpoint. The economic sentiment indicator is also influenced by some of these high frequency type cost factors, which we know have been trending a little bit favorably lately. But these upward trends are being generated really, I think, from this more macro perception of the economy slowing down, which is kind of putting a damper on some of these prices. But needless to say, I think it's good to see that the sentiment numbers have maybe troughed, at least on an interim basis, and maybe trending up just a little bit, even though they still remain fairly weak. Here is gasoline prices. You can see we're down a little bit less than 50% from the June high. I think you look at the beginning of the year, we're not too far. We're very close to where we started the year, but as you can see, gas prices can change rather quickly. Here's home buyer mortgage payments. We see that those are up 40% year over year. You can see the trends in 2020 and 2021. Below that, you can tell that the rate of acceleration has been very profound. The first half of this year, we do see a bit of moderation here. Some of that has to do with the gyration in interest rates, but with regard to the overall trend relative to the last 2 prior years, a lot of it has to do with home price appreciation. Here's the used car index. One thing that we were talking about very early on when we began to witness this hyperinflation that we've been dealing with is the cost of used vehicles, used cars, and we've seen some fairly dramatic increases there, but lately we've seen decreases. And again, some of this has to do with the global drop in demand. Some of this has to do with some production increases, although there's still some supply chain choke points that remain. But overall, we see demand for this type of discretionary purchase going down a little bit. In fact, trending currently in negative territory. Here is some data from the San Francisco Fed, or at least compiled by the San Francisco Fed on national data. We see inflation as it's defined by personal consumption expenditures on the left-hand side remains relatively high. I think PCE inflation right now is trending a little bit over 6%. You can see the trends that are been well identified over the last several months. And on the right-hand side, you'll see demand for goods remains relatively high, but I think this has manifested itself in some of the high-frequency data. We saw iron production, falling negative, and I think that's borne out in this right-hand chart where we see those trend lines rolling over and trending closer to that long-term 2015 to 2019 trend. Personal savings rates. Now, we do see that people are continuing to spend and support consumption. A lot of it has to do with these 2 factors right here. One, we've got the personal savings rate is at the lowest point that we've seen since 2009. We're down around 5%. Of course, the last couple of years, people have benefited from stimulus checks, and that's obviously no longer in the cards. On the right-hand side, we've got consumer credit, and we do see that we're currently at consumer credit rates that we haven't seen since 2011. Now we're currently up about 7.7% on a year-over-year change, and you can see that chart as presented to us by Charlie Bolello and his Compound publication. You can see where that has gone lately, and we were actually trending negatively for a brief period of time when we had all of these stimulus checks and with savings was very high. You could see credit contracting, but that has obviously changed. Here's durable goods inflation is down notably, and that's in the left-hand side. And you can see consumption of services down below trend as well on the right-hand side. So the left-hand side gives us a window into the demand destruction that's being born out of this high inflationary environment. And you can see that that is coming off its peak. It's still well above its longer term trend line. So, from a purely statistical standpoint, I mean, there is room for durable goods inflation to come down a little bit more. Now, on the right-hand side, we've got PCE, personal consumption expenditures on services, and those are continuing to move higher, although it's not clear in this analysis right now whether we're going to be able to reattain that 2015 to 2019 trend anytime soon, because as you can see here, the rate of acceleration or reacceleration from the pandemic low is beginning to temper a little bit. We're seeing that trail off just a little bit. Here's a chart on the US dollar, and you can see that that the euro to dollar rate is at its lowest point since 2002. In fact, we've pierced through that parity level where it used to be it wasn't too long ago, as you can see here in this chart, that we had a euro that was basically 1.35 or 1.3 or 1.4, and that's obviously changed. And now we've got a euro that's trading below parity for the first time in a long time. And then on the yen as well, we've got the lowest yen to dollar rate that we've seen since 1998. And so when you think about the the DXY, or the kind of the trade weighted dollar index. It's as low as, excuse me, the dollar index rather is at its highest point in over 20 years. Here's a 30-year fixed mortgage rate. No surprise here. We see that reaccelerating. We got a little bit of relief off the peak, but we continue to move higher since then. So we're closer to 6% on the 30-year fixed rate as reported to us by Freddie Mac. Average rent prices continue to move higher. Good news is here that we see a rate of deceleration from the peak. Now, that's not to say that rents are going down by any stretch, because you can clearly see that they're not. But in the green bars below, that shows you the rate of change. And so the rate of change really peaked, some months ago, back in October of 2021. Continues to move higher, as we knew it would, because rents lag prices by about 9 to 12 months. And so we knew that this was coming. But I think in many respects, it's good to see that the rate of acceleration trending lower. Here's a really good chart from Liz Ann Saunders of Charles Schwab. Gives us a lot of information on this one particular slide. And so it's got data here from the S&P 500, NASDAQ, and Russell 2000. And so just looking purely at the year-to-date numbers, and this is data as of 9/8, so it is pretty current. And we're down around 16% on the S&P, down around 24% on the NASDAQ. We know technology has really taken it hard. Russell 2000 small caps have also been hurt. Russell 2 is down around 18%. And we see from peak to trough, from the year-to-date high, the S&P witnessed a drawdown of 24%. So in other words, from the peak of the year, which we know was earlier this year, the S&P was down at one point 24%. NASDAQ was down at 33%, and then the Russell 2 was down 27%. So you can see the drawdowns were fairly dramatic as we meandered through the first half of the year. And then the next column gives us the average member maximum drawdown. This would be the maximum drawdown for the average stock within the index. And that was down actually more than the index itself, because we know that energy has been pretty strong this year, relatively speaking. So the average member within the index for the S&P 500 was down around 30%. But right now we're about 9% above the year-to-date low on the S&P 500, and so it gives us a frame of reference for at least in terms of what we might expect if we trend to a recessionary environment. That the typical recessionary drawdown is around 24-26% in that ballpark, depending on which index that you're looking at. And you can argue that we are already there, but we do know that leadership in 2021 was led by technology, as it was at various points in 2020 as well. But again, just from a drawdown standpoint, it's clear that we've seen a lot of movement already. Here's a quick slide on net foreign purchases of U.S. equities and fixed income. And as we get into 2022, we know that bond investments coming from foreign purchasers has gone down. Meanwhile, equity purchases from these same foreign investors has actually gone up. So as you see the U.S. becoming very much the best house in a bad neighborhood, a strong dollar, so on and so forth, investors are clamoring for those returns that they could then, then maintain investments in the U.S. We're getting more direct foreign investment for investments in the U.S. A strong dollar is helpful in that regard, and also the quality and integrity of our markets right now certainly plays into that as well. Here's the expectations for inflation over the next 3 years. You look at this three ways. You got the longer run target, which is in that solid flat green line, and that's around 2%. That's a number that we've been looking at least the Fed's been talking about in its earnest desire to get back to from their aggressive monetary policy actions. You can see the headline numbers, where we've come in just a relatively short period of time. You can see the peak in the headline. and also see the peak in the core. And I think it can be argued with some degree of confidence now that maybe we've seen the peak, especially if we get demand destruction. That will certainly help bring these prices down, and that is exactly what the Fed can control with their interest rate policy decisions. And you can see the trajectory of the decline. So, obviously it's going to take a while to get down to that target, but it's really looking to get closer, within the next within the next couple of years. Here's a household survey. Again, this is put together by University of Michigan, and this is their consumer sentiment numbers, and they see, over really the main thing to look at, and the short-term indicators are highly influenced by what people are seeing, at the gas pump and whatnot. And we just talked a few slides ago about how that is rolling over, and that has changed dramatically, and how the sentiment numbers have improved as of late. Well, you can see that manifest in this blue line where the next year, the forward year inflation expectations are coming down, but they're still high. I think what's important here is that green line that you see, and that's the 5 to 10 year outlook in this survey, which has really been anchored for a long time around 3% and started moving lower as realized inflation was around the 2% level, and then now it dipped, and now it's going back up to 3%. A quick look in on the labor markets. This is a chart that does a really good job of explaining what I've been talking about for quite some time. There's essentially an oversupply of available jobs, and there are workers to take them right now. And you can see here available jobs re-accelerated following the shutdown and that very short recession during the pandemic. And you see the peak year occurred a little bit earlier this year, and we do see that available jobs are moving lower, and I think that is a signal for things that we should look forward to. Again, typically as you head towards and enter a recession, that you have job availability going down, and so this would certainly be consistent with that. But then you see in that green line available workers. So there's a lot of labor mobility right now. And as we've talked about in other weeks where we've had charts on this, the participation rate has actually improved a little bit as we see older workers that had exited the workforce beginning to get back in. But there's still this odd disparity here where we have more jobs than there are available workers, and certainly unemployed workers. Labor productivity, we know, is going down a little bit. Some of this was, kind of post-pandemic. We saw a little bit of improvement there, and I'd say we're in perhaps a bit of a productivity recession now, if you will. And you see that the productivity is in negative territory now. And productivity for a long time, when we had globalization, was a strong contributor to keeping inflation low. And so the theory is that we have labor productivity dropping, then that's less of a anchor around the neck of inflation. And I think in some respects has helped inflation to expand to a degree. And obviously we're deglobalizing economies and moving supply chains home, and things like that are, I think, not necessarily helping the inflation picture. But again, I think it's a trend that is been in development for some years, and I don't see that trend is changing that much. Now, on the right-hand side, we have unit labor costs, and those continue to move higher. We're at a very interesting juncture because, as I said, we've got unemployed workers that have more than one job to choose from. We saw that in the last page here, but then unit labor costs are going up as the competitiveness has certainly increased for workers, and there are still. And because of this, increasing labor mobility, ideally with people being able to work remotely now, in many respects, is creating a huge problem for employers that are now having to pay up for labor costs. And I think this part of the inflation picture is going to remain fairly sticky for some time. Here's I guess what we'll begin to talk about in the markets. You know, you've got third quarter S&P earnings estimates, and we're going to start to get this data in just a little over a month now. You know, September 30th will be the end of the third quarter, and then at least now we've got these estimates that we can begin to kind of take stock of, and you can see that the overall S&P 500 earnings estimate is expected to be negative to the tune of about 5 to 6%. And outside of energy, you can see that most of the other GICS sectors are apt to witness a decline, with technology perhaps witnessing the biggest decline. Now, if you want to go out a little bit further on the spectrum on the right-hand side, and you know, they all look very similar. This one just happens to be the earnings estimates coming out of Morgan Stanley's research department. You can see the actual S&P 500 trailing 12-month earnings growth rate, and you can see, you know, the gyrations there. You know, typically if you overlay recessions, you know, you see troughs there, and then you see reaccelerations from that point, and that was certainly no different in 2021. Now, you know, we are coming off the peak, and we've anticipated this for quite some time because we knew the earnings growth that we saw last year was not sustainable, and then coupling that with the increase of inflation and interest rates moving higher, and this desire by the Fed to really want to choke off growth to help stem the inflation picture. Again, you know, inflation by its nature is, too much money chasing too fewer goods, and if you have demand decline, then that's going to bring that inflation number down. And obviously, that's what the Fed is trying to do. And so you know that these numbers are coming down. Now, the overlay on this, you can see that the earnings estimate, this is a leading economic indicator that they put together. And again, Citigroup, JP Morgan, they've all done this work, and it all pretty much looks the same. I just happen to show Morgan Stanley's here. But, you know, really looking for, you know, what they're calling kind of an earnings recession. And that would be a longer term kind of extrapolation of that left-hand side, which is just the third quarter. So they're looking into next year saying, listen, we're going to have negative earnings, you know, out maybe, you know, the next 9 to 12 months. And that's not unreasonable to assume. In fact, I think it's fairly well baked into the markets now that are still kind of struggling to find out, exactly how much demand is going to drop and by how quickly can it drop, and how quickly can we get through this trough in this recession to get to the emerging new economic cycle on the other side of it. And so a lot of speculation is built into these numbers, but right now I think it's clearly assumed and baked into the market that we're going to have negative earnings over the next 9 to 12 months. Here's some interesting research from Guggenheim, and it just says that, you know, when you have higher inflation, you tend to have lower stock valuations, and that's very well understood, very well researched, in fact, and Guggenheim in particular does an excellent job of synthesizing a lot of this research for kind of the general public to consume. And that's what we have here. So when you see, you know, on the x-axis or the horizontal axis, you see levels of inflation rates, and they're using the core personal consumption expenditures index on a year-over-year basis. And where we are now is about 4 to 5%. Again, that's not CPI, it's not core, it's not all-in CPI, which is different than this. But you know, right now it supports about a 15 times multiple of earnings. That's a value relative to the earnings level. And again, we just saw on the previous slide that we do expect earnings to come down. And so, you know, that makes the multiple a little bit more sensitive. So obviously when you have lower inflation, it supports a more accelerated growth. But right now we're dealing with higher inflation, but we think it's coming down. But it's also coming down at the same time that earnings is coming down. And so that puts us in a real interesting spot. And I think if we, you know, certainly if we reduce core PCE inflation down to maybe the 3 to 4% range, maybe even like just slightly at or maybe above 4 because of demand destruction, then that allows the equity market to support itself a little bit better than would be the case if we assume that inflation was continuing to go up. And I think, again, I'll go back to my statement earlier about saying I'm actually grateful that the Fed has decided to become more aggressive about beating inflation and saying in Jackson Hole, Wyoming, a few weeks ago that they're going to be aggressive in trying to bring inflation down, because I think that gets us to the next cycle, the next up cycle, a lot sooner than would be the case if they had said, hey, we're just going to watch the data. It will be data driven and we'll kind of see how things go. Well, they came out and they said, this may cause some pain, but we're going to get this done. And I think that's getting us to a more favorable spot sooner than would be the case otherwise again. Here's a chart of net inflows into equities, and you can see, and these are retail accounts, so these are through brokerage houses and through Robinhood and various portals like that. And you can see that those numbers, just looking out over a handful of months, really, daily net inflows into equities continue to trend down as the apprehension, I think, becomes a little bit more entrenched. And at some point, you get that aversion to equities going down so much that then you have the speculators and the value investors begin to come back in. Well, in our last slide of the day, we'll focus on credit and the fixed income markets, and something that I think we should be looking to some degree as we head into the latter part of the year. Usually when you see demand growth and economic growth overall slipping, you tend to expect higher credit spreads. And what this means is that and these spreads, ironically, have been super tight for most of the last couple of years. And it was just a reflective of a high confidence level that you weren't going to have a lot of defaults. We were in a growth mode coming out of the pandemic. In fact, accelerating growth in a lot of areas, particularly in the goods side of the economy. But yeah, now that we're kind of transitioning into a period of slower growth, you'd expect that those, the risk of default to go up. Now we haven't seen a big spike in defaults, so it's not there, but the perception by the bond market that you're going to at some point in the future tends to influence how some of these bonds are priced. And so right now we see in the red hand side is a business cycle financing index, and it's advanced 12 months. So it's meant in this case to serve as kind of a leading indicator of what we should expect to see in high yield spreads. And you can see that in the black line, and that's actually an inverted number. So a black line moving lower would imply higher credit spreads, which would mean essentially a higher difference between the risk-free or the perceived low-risk bonds and the yield on the high-yield bonds. So when you think about this, you build in when rates are moving higher and you've got a higher risk of default, you're going to demand more return for that increased risk. And so that's what this whole notion of spread is. And so when spreads blow out or they move higher, what that means is that the market is pricing in a much higher probability of default rates within that particular segment of the fixed income market. And so that's what we're looking at here. We're expecting high yield spreads to move higher. As a result, we're taking steps to kind of minimize our exposure there. Again, we are absolutely data driven in that regard. And so clearly we're making some changes in the portfolio to kind of reflect that thinking. Well, that is all that we have for this week. Hope you've enjoyed the chart pack. If you have any questions, there's our contact information. We'd love to hear from you. Hope you have a wonderful week, and we look forward to seeing you again soon. Take care. Bye.